Hello, everyone, and welcome to today's episode of Macro Microscope. Today's topic is divergence and dispersion. I'm Indrani, head of global investment research at FTSE Russell, and I'm joined by John, director, data stream and macroeconomics. Uh, just a quick disclaimer, everything said in this presentation is purely for educational purposes and not to be taken as investment advice. With that, I'm going to turn over to John, our first speaker. John, on to you.
Hi, thank you, Indrani. Thank you very much. Hi, everybody. Welcome to the second episode of Macro Microscope. In terms of policy divergence, I think we first need to look at where we've seen policy convergence from the central banks. Post the GFC and the sovereign debt crises, with the central banks dropping interest rates to near zero levels, and also the effects of globalization, consumer inflation fell very, very low. And as you can see there, hardly ever went above 2%, didn't stay above 2% for any given long period of time in the years from sort of 2013 to 2020. And then, of course, with the pandemic and the crunch on the supply chain, we see massive increases in consumer inflation. And then all of this is very convergent, right? We can see that all the central banks felt they could engage in policy that was very similar, one central bank to the other, which led to higher interest rates. But when you look at where things have started going slightly differently, if you look at money supply growth rates first, you'll see that central banks have started diverging, where they would tell us there was a lot of quantitative tightening taking place and the raising of interest rates, and also a decrease in the money supply. This chart here shows you that sort of late 2022, early 2023, central banks started increasing their growth rates of money supply, their broad money measures. When you look also at the financial markets for some of these central banks, the domestic markets they're forced to operate within, the United States has to sort of keep its rates high because its 5-year interest rate swap rate is moving sideways. The ECB's got a different issue. Their 5-year interest rate swap has sort of started to show that it's going to come off a little bit. And of course, we know that the European Central Bank was one of the first G7 central banks to cut its rates at the start of June. And the last slide, Indrani, that I want to just take the audience through is with the Japanese yen. The Bank of Japan is now completely divergent from the rest of the G7 central banks. Where all the other central banks are looking to cut, the Bank of Japan is looking to raise, and primarily looking to raise, not so much because of inflation, but more to do with yen weakness. And as you can see here, at the end of Q2 of 2024, the yen was at its weakest rate since early 1990. And we know that the Bank of Japan has intervened, along with the Ministry of Finance, to try strengthen the yen. And the other way that they will do that is to raise interest rates to nullify the effect, as much as they can, of the yen carry trade. Over to you, Indrani.
Thank you, John. So I'm going to touch upon this topic of divergence and dispersion more from the financial markets angle. So I want to touch upon this, the 60-40 portfolio, a diversified portfolio with both stocks and bonds. That's really the cornerstone of portfolio construction. It's really underpinned by the correlation between stocks and bonds. So the chart I have here is the correlation between the US 7 to 10-year treasuries and the US equity markets Russell 1000. And what we see is for 25 odd years starting 2000, the stock bond correlation was either deeply into negative territory or very slightly into positive territory. Stock bonds were really providing diversification benefits. But today, in the last couple of years, this correlation is very high in positive territory. And the last time it was this strongly positive was all the way back in the mid-1990s. So something has clearly diverged from the recent years. What could that be? As John talked about, we saw a lot of inflation. And I think that is the driver why this divergence happened in the stock bond correlation. The scatter plot that you see, it kind of plots the correlation between the inflation that we are seeing and the stock bond correlation at that particular point in time. And you see most of the data points, the dark blue points, show that the correlation was in negative territory, and also inflation was 4% or much less. And you see the recent data points, which are in light blue on the top right. Two things. The stock bond correlation is very high, and the inflation regime is much higher. So that tells us that yes, inflation and the resulting short rates have a strong impact on what the stock bond correlations are going to be. And this relationship doesn't seem to be linear. There seems to be some kind of a break point at around 4 percentage point of inflation. Less than that, stock bond correlations are low, you get the diversification benefits. Inflation higher than that, around 4 percentage point, stock bond correlations are much higher, and you don't get much of the diversification benefit. Another thing that I want to touch upon, and this is more from the angle of dispersion and more from the equities perspective. So here we are looking at the cross sectional return dispersion within broad equity markets, whether it's the all world, the developed indices, or the emerging market indices. So, how much is the dispersion within each of these broad categories, which essentially shows how different markets within that broad index are behaving? And you see some clear trends. Dispersion went up sharply during the financial crisis, and since then it was steadily decreasing till in the post-COVID era. Again, the dispersion has increased, which means within developed markets, different countries are behaving differently. Within emerging markets, different countries are behaving differently. And a very strong example that comes to my mind, John also touched on Japan. Japan has been behaving very differently in the last 2 odd years. It was very strong. Japanese equities were very strong in 2023. And even in 2024, year to date, if you see, if the all world equities is up around 14.5 percentage points, Japan is up to almost 12 percentage points. Japanese equities are doing very well. And that's very different from the very long period of time pre-COVID that we all heard about. Japan is in stagnation, their financial markets not doing well. So Japan's comeback is another example of the divergence and points to the dispersion within markets. We recently also wrote a paper on this topic, what led to Japan's comeback. And with that, we hopefully pointed out the divergence and dispersion in the market. And thanks everyone for listening to this talk. Bye now.
Thank you.